Welcome to value creation. This is the quick and dirty version. Most of you have all seen this before. Sometimes it helps to see it again. Sometimes it helps to see it a third time. And sometimes it's just useful if you see it on a different day. So I'm going to cover some ground that we've already covered before. And I'm also going to introduce a few other bits and pieces as we go along the way. So let's dive on in. I'm going to go quickly. There's lots to cover, and you can obviously stop and rewind at any stage. So value creation, McKinsey appears to be the prime source with regards to the theory on this. We might have covered several different sources of value creation. You would have looked into the valuometer while we were in class, but in principle I've just highlighted here the primary core value creator component, and that is that our returns must be higher than our cost of capital, and this is well emphasized in both these publications of McKinsey. We also came across Eric Beinhocker, who suggested that the objectives of every business are to endure and grow. We looked at profitability, the impact of growth, capital, and the value creation component, and I'm going to cover that ground here again. And since Eric Beinhocker starts with profitability, it kind of makes sense to go to the income statement, and that's where we're going to head off first. But as we arrive there, we see these terms ops and capital at this stage has little meaning if you've never seen it before, so it actually makes sense to go to the balance sheet and start there and recognize that there's a view of the world according to accountants, and there's a view of the world according to the kind of business finance community, if you want. So let's start off with the accountants and see how they view the world. They see it very much as a liabilities and assets world, where you have liabilities in the source of equity and debt and current liabilities, and we use these in order to fund the purchase of assets. If you break it down a little bit further into the terminology that we used in class, we just said equity plus debt plus current liabilities is equal to the fixed assets plus the current assets. Knowing that I'm leaving out some goodies here in terms of intangible assets and investments and loans, and for our purpose we're just going to bundle them up into this descriptor of fixed assets. So that's the view of the world according to accountants. My suggestion is a different perspective on business. We don't want to look at it in terms of how accountants look at it, but rather in terms of how business people look at it. And my reason for this is primarily I want to remove these current liabilities because they have no capital cost. I should put a little exclamation mark there. They do have a capital cost if you offered early settlement discounts and choose not to take them. However, for our purposes, we're just going to suggest that there's no capital cost. So I'm going to move them across to the other side. To do that, we take this finance view of the world, and here you can see in my formula below, the CL has moved across to the other side. It's become minus CL. In doing that, we created the working capital here, CA minus CL, and now what we have on the left hand side is just equity and debt, and we're calling this now capital instead of liabilities, and on this side instead of assets we're calling it operations. So in class I probably referred to something known as your work address. Do you work in the operations suburb or do you work in the capital suburb? And the result of that conversation is almost always the same, is that 90% of the organization sits in operations. It's only the few who relate to dividend policies and capital structure that find themselves in the capital suburb. So once we've orientated ourselves in terms of which suburb we're in, we can now head back to the income statement, and we can now look at the income statement in terms of operations and capital, where the top half of the income statement is the operations component. So obviously, being in sales, I refer to this as sales street, customer focused, and obviously coverage falls into that space, looking at all the different ways that we can transact with the customer across the entire wallet. Cost of sales is also very operational. Often it's delivery of product or delivery of service, might contain logistics. You will see in the background here a few little more detailed information. I'm not going to go into that now. That's for a more detailed look into some of these dynamics. Moving a little bit further down the income statement here, the expenses, overhead costs, fixed costs, etc. What we're really interested in the operations is what is the operating profit that's being generated. That is the primary measure of the performance of the operations suburb, if you like. And if we drop down to the bottom half of the income statement, here you're going to see the expenses that relate to the debt in the business, interest expense. This interest income is a bit of an anomaly because it's not part of the capital side of the balance sheet. In fact, interest income can often be part of the operations of a business. A typical example here are companies like Truworths and Fushini, where interest income is primary to the operations. We need to make an adjustment in the calculations to recognize that interest income should actually be included in the operating profit, and hence there's another adjustment that one has to make in order to convert from the accounting view to the finance view of the business. Further down here we find the dividends, and of course that directly relates to the equity component of the business. This issue of tax creates problems in here, especially when we're trying to identify performance. So a little bit later on, when we get to calculate NOPAT, net operating profit after tax, we make some adjustments to move the tax up into the operations component. So those are some subtleties that come further down or further along in the journey. So once we've now looked at the income statement and we clearly define where our areas of operations are, we want to go and look into some performance. So again, here's our view of the balance sheet. On the left hand side you've got the capital, on the right hand side you've got the operations, in the same way as we looked at it earlier. You'll notice now some other numbers have crept in here because now I'm identifying capital structure here with these percentages, and I'm identifying the cost of these different sources of capital, and overall trying to calculate a weighted average cost of capital. So let's dive in a little bit deeper here and explore what are the components of equity that are relevant to us when we are talking value creation. And of course we know this is money from shareholders. It's the share capital and the retained earnings over time. But what I'm interested in here is what are the returns that shareholders can expect in a business. Of course we're talking South Africa primarily, and we're talking listed companies who are accessing capital through the capital markets. And our ALSI returns chart is very useful in order to identify what is the potential opportunity cost of attracting shareholders' interest or shareholders' investments. And we talk here about the expected returns that someone can get from making an equity investment. We're using the number of 18%, and that comes directly from the cumulative average growth rate of equity returns. That component includes share price and dividends. Share price growth is between 15 and 16% per annum, and the dividend yield is between 2 and 3%, making up the 18%. So that's the number we're going to use, specifically not looking at any CAPM details here. We're just using empirical data from the equity markets. So let's move on now to looking into the debt. Well, we know debt's typically borrowed money. We know it's time bound, where equity is not. There's this beauty of the tax deductible expense that goes with debt, because the interest expense is tax deductible. I'm assuming for my calculations here that we are borrowing at the prime lending rate in South Africa, which was until recently 10%. That has just changed, just gone up by 0.25%, but for now we will go with 10%. Corporate tax rate in South Africa at 28%. So we calculate this thing called the after-tax cost of debt using the tax shield. And when we plug those numbers in, it turns out that debt in South Africa costs about 7.2% if you're borrowing at the prime rate, and also assuming that the business is profitable. Unprofitable businesses don't get the benefit tax deduction that comes with the interest expense. So now what we've been able to do is get an equity cost and get a debt cost, and we can combine them in calculating or in exploring some of the details of the total capital. Of course, here we're talking equity plus debt, and we want to know the capital cost. Here is the cost of capital formula, and what's important to recognize here, the equity percentage, we are using the market value of the equity, not the book value. And to get the market value of the equity, we need to know the number of issued shares, and we need to know a share price. So this implies that the company is listed. If we don't have a market value because it's an unlisted company, we default back to the book value of the equity. Or sometimes I've seen a kind of a hybrid model of trying to determine a market value of the equity, but that creates complexities that are not necessary for our conversation here. So when we plug in the numbers there, we have this debt cost of 18% with a 90% proportion of equity. And here's the sorry, did I say debt cost here? I meant equity cost plus the equity proportion. And here we've got the debt cost and the debt proportion. We multiply each of these components out, and we end up with a cost of capital in South Africa for many businesses that turns out to be very close to 17%. Of course, businesses not using any debt, we would simply use 18% as a cost of capital. So from here we can look in again to our balance sheet and recognize here's the amount of equity times the cost, the amount of debt times the cost, getting us this weighted average cost of capital, which is such an important number, because when McKinsey talks about generating returns that are higher than the cost of capital, it's that 17% that we're going to use. And what's happening here is those who work in the capital suburb are raising this capital at a cost of 17% per annum, and they're handing it over to those in the operations, and they're saying use this capital in the form of assets in order to generate returns that are higher than the cost of capital. And therein lies this primary core, if you want, core component of value creation. So from here we are going to take a closer look at some key performance ratios that help us uncover whether a business is creating value or not. And I recognize that at first glance this looks like a spaghetti junction here, but we're going to zoom in a little bit and we're going to look into the RONA, return on net assets, and we have an equation here that simply takes the operations, profit from the operations, and divides it by the net assets used in the operations. There's this like for like component, and we want that RONA, whatever it is, to be higher than the cost of capital. And really what we're doing here is we are measuring the performance of the operations. And it doesn't make sense to measure the operational performance and include in that issues that relate to interest expenses and tax efficiency and dividend policies, etc. So that's why it's so useful to make these adjustments to the way we look at the balance sheet. So just some other terminology that's important to be aware of. We use the term RONA, but there is also return on capital employed. There's also return on total capital as other terminology that is used. A more refined version is this one down here called the return on invested capital. Here we're not using EBIT, we're making some adjustments in order to get to this terminology or this measure called NOPAT, net operating profit after tax. And down here at the bottom you can see how in order to find NOPAT we're taking the operating profit and taking out the tax expense in order to get a more refined version of the operating profit performance. In addition to that, what we often do is we add in the interest income. So we add it into this NOPAT in order to get an even better measure of the performance of the operations. So that talks to RONA. We are then going to look, of course, at the return to shareholders, commonly known as return on equity. And here you'll see we've dropped all the way to the bottom of the income statement. We're using this earnings after tax number, or net profits if you want to call it that, profit after tax, and we're measuring it against the equity in the business. Now, what this does is it gives us an output that tells the shareholder if they're generating returns that are higher than the cost of capital. I must just pause here for a moment. When we do these calculations, this earning after tax over equity, we do measure this against the book value of the equity in terms of rands or dollars or whatever the currency is. We don't use the market value in this context. We only use that market value when we are calculating the cost of capital, as we did earlier. Alright, so those are these two measures, and I want to just dig in a little bit more because we did this in class. We did some, what we referred to as some, I often call it income statement gymnastics, but really what it is a dive into the decomposition of RONA. So we know that operating profit divided by net assets is what makes up RONA. But what I'm doing here is a little smoke and mirrors. I'm taking this formula, I'm multiplying it by sales over sales. We know that's 1. We know it doesn't alter the outcome of the formula. But what we can do is we can swap the denominators. And I've done that here in order to isolate these different components of the formula, where we have the operating profit and the activity. And to find the operating profit, we come here and we say EBIT divided by sales. And that measures profitability of the business. And to find the activity, it's sales over net assets. And what this produces is a neat little dashboard that is really simple to use in order to decompose if RONA is going up or down, why it's changing, how do we need to act in order to change it, what are the activities that are required by management, what decisions have got to be made in order to drive return on net assets. Knowing that there are only 2 variables in the formula. Of course, I know that under profitability there is so much more. There's product mix, there's pricing, there's volumes of sales, there's overheads, there's all that stuff that comes out of the operations of the income statement. One might suggest that there's lots of variability in there. But as long as we understand how our actions in here ultimately drive operating profit, that's the key for us here. And of course, at the end of the day, we want to drive up sales. But you don't want to drive up sales by arbitrarily using more assets than the business needs. So that's the efficiency component that drives return on net assets. From here, we're diving into the decomposition of the return on equity. Very similar process, it just has one more hoop that we've got to jump through here. Here we're taking the profit after tax over equity and we're multiplying it by sales over sales and by net assets over net assets. We can swap the denominators in order to identify these 3 components. PA now is profit after tax. Here we go. Earnings after tax divided by sales. Again, it's a measure of profitability. It's just coming from further down the income statement. Activity is how we utilize those assets. That's the same activity number that we use in RONA. But now ROE adds this extra component of leverage, which is really the measure of how much debt we use in the business. Knowing that this is not measured as a percentage, it's measured as a function of 1, where if the leverage is 1, it means the business has no debt. And here you see this total capital over equity, and I've used total capital over equity because net assets and total capital are equal. Net assets over equity is the actual formula, but total capital over equity does the same job for simplicity reasons. So we have a dashboard. In fact, we have 2 dashboards. We have the RONA dashboard and we have the ROE dashboard. And the subtlety inside those dashboards never ceases to amaze me in the way that they can be applied to so many different businesses. So as we pull back from that, in this combined picture, we're seeing the levers that drive profitability, activity, the leverage. There's the ROE in here, there's RONA. It's all together. It's one neat little diagram of what's driving performance in a business. So from that, we kind of head back to the beginning. Here we are, quick and dirty. Now, it's useful, I find, to have a little crib sheet, because I often get asked, so how do I present all this data, all this complexity in a one-page slide to an audience? And having been asked that question so many times, I created I call it my crib sheet, my cheat sheet if you want, into what are the key aspects of value creation. How do these stack up all together on one page? And across the bottom here, now you see something that you recognize very clearly: profitability, activity, and leverage. I've taken these headings, if you want, or these components, I've given them some space here in my crib sheet. Here's profitability, here's activity, and here's leverage. And under each one of those, I've shown the components that are critical. I've also introduced here my more higher level, if you want, my more policy orientated finance strategy stool. And you'll see the comparisons. The dividend policy is a function of profitability. You can't pay a dividend effectively unless you are profitable. And how much dividend is paid is often driven by this profitability. The investment principle in a business, how assets are utilized, where we invest our money for future growth, is also a function of activity. And here the capital structure is definitely a function of debt and equity, or this terminology here is leverage. So under profitability, here you'll see the headlines. Income statement, it refers to margin, it's the overhead components of the business. You can talk about the operating leverage in the terms of fixed expenses versus variable expenses. There's all sorts of break-even dynamics that happen around these variables. Profitability is a function of growth. The more dividend that is paid, the less money there is retained in the business to grow. So hence the dividend policy sits here quite neatly alongside growth opportunities. Lots of growth opportunities, maybe less dividends that are paid. Then we might look into the actual growth rates and sustainable growth rates of the business. We might measure these, compare these, ask ourselves, what are the dynamics around these when we need debt funding? A function of profitability, NOPAT, more refined version of it, where we're taking the tax out from the operating profit. We might also add in any interest income as part of calculating the NOPAT. In the context of fixed assets, we're talking about the asset turnover, we're talking about the working capital turnover. These measure the efficiency with which we use these assets. Getting into more investment orientated thinking, we're looking at net present values. Here we're discounting future cash flows, and we're discounting them by using the WACC as the hurdle rate. So this is all about the time value of money and how effectively we invest in certain assets. Well, leverage, we know all about that. Here we're talking optimal capital structures. What's the correct or most appropriate balance of these two sources of capital? What's the effect of the dividend policy on the amount of debt in the business? You might be paying out large dividends that can affect the capital structure. So we might be talking debt capacity. If there's growth opportunities and the business is taking on debt, we want to know what is the debt capacity. Cost of capital, of course, is important here, and feeding into the component of risk. Debt is a risk component, and debt shows up as an interest expense, which is a fixed cost, which is impacting back in the income statement, and hence this cross coverage nature of all these different components. Down here in the bottom right corner, the part that counts the most, generating operating profits, so that those operating profits are more than the rand cost or dollar cost, whatever currency you're operating in, of the assets that we are using. So this is a slight variation on EVA that I've adjusted just to make it a little bit more user friendly. And what you have here in the end is a crib sheet where if you can touch on all these points as they relate to a business and identify the impact that they have on performance, well then I think you're going to have value creation completely sorted. So thank you for listening and welcome back to the quick and dirty version of value creation. Until next time.